On this March 11th, in a couple of weeks, it'll be 77 years since I bought my first stock. And I paid $114.75 for 3 shares of City Service Preferred. But if you had if you'd been a pension fund and you put $1 million into the S&P 500 at that time and reinvested it, during my investing lifetime, that million would have turned into $5.3 billion. You would have gotten, for every dollar you put in, you've gotten over $5,000 without ever reading a headline, an annual report. You didn't have to know accounting. You just had to believe in America. And you didn't have to pick the right stock. You just picked America. And I go back and I point out that there were 2 77-year periods before that, and that takes us back to George Washington getting inaugurated. And there wasn't anything here then. And now you have $108 trillion of household wealth in the United States. You know, we've got something that works. And that framework wasn't that we were working harder, it wasn't that we were smarter, but we had a framework that unleashed human potential. And just think of that, 3 77-year periods, one of which I experienced, and you couldn't help, but all you had to do was believe in America.
That worked the last 77 years, but there's a question that came in, T29. This is from Scott Baker. With so many people in the S&P index funds, is it still market neutral and the best investment vehicle for most people?
Yeah, I think it's the best investment, because most people don't know how to pick stocks, and most of the time I don't know how to pick stocks. I mean, it's not an easy game, and by definition, people are going to do average. I mean, take everybody in aggregate, and if half of them are paying big fees and jumping around and paying brokerage commissions, the other half have to do better. The S&P 500 is, I don't know whether it's 80% of the market value of everything you can buy in this country, and it's over. I think it's over 20 trillion, and you're buying America. And let me give you a figure that'll blow your mind. I think I bought my first stock when I was 11 years old. It was the first quarter of 1942, shortly after Pearl Harbor. I spent $114.75. 3 shares, $114.75. If I put that 114 into the S&P 500 at that time and reinvested the dividends, think of a figure as to what it would be worth today.
Oh man!
Well, it's
okay.
I just want your audience to think for a second.
Okay.
The answer is about $400,000. Oh. So if I, as a little kid, had taken that $114 I'd saved shoveling snow or whatever I'd done, $400,000 today, one person's lifetime. That's America. I mean, that isn't me. It is the huge tailwind the American economy gives to any equity investor. Now, the market's gone down many times during that time. People have panicked during that time. Headlines have been terrible. It looked like we were losing the war when we first bought it. But America is a powerful economic machine that since 1776 has worked, and it's going to keep working. Now, you don't want to buy to hold for a year. You don't want to buy with the idea that you could sell it in 2 years or 3 years, necessarily make money. You could lose money that way. But if you buy it for 10, 20, just keep buying the S&P 500 index and forget about all the other nonsense that's being sold to you, because I'll guarantee you one thing about the stuff being sold to you: it will carry bigger fees than what I'm talking about.
Yes.
Yeah.
And there's no reason to think that we don't know if it's 400,000, but that same sort of process or returns won't happen starting right now.
The S&P 500 companies have earned well over 10% on equity, often 15% annually for years and years and years and years. They've done it with Democratic administrations, with Republican administrations. Now, you get money compounding at that kind of rate underlying your investment, and you get a diversified group of that. I mean, you're going to do well.
Now let's jump into the top 3 ETFs that you can use to generate passive income by the power of compounding, like Warren Buffett said. I'm starting out with the 3rd on the list, which is the Invesco S&P 500 High Dividend Low Volatility ETF, ticker SPHD. This is quite a small ETF with $3.1 billion under management. a whopping 3.71% dividend yield, and an expense ratio of 0.3%. Now notice that this ETF has an expense ratio that is quite higher than what you have seen in the different S&P 500 ETFs we've talked about severally on this channel. And the reason for that is this ETF focuses on the components of the S&P 500 that actually pay quite high dividends. Breaking down the sector weightings, you can see that this ETF is quite diversified across the different sectors, with the biggest weights allocated to consumer defense at 18%, healthcare at 13%, and utilities at 19.27%. And the different companies that make up this ETF are spread across those different sectors. We have Iron Mountain, Altria, AT&T, Philip Morris, Chevron, the oil giants. So you have quite different companies that do not take up more than 4% of the total asset of this ETF, which further speaks to the diversification in this ETF. So this ETF came in as number 3 because I like the different profile of the investments in the ETF. However, I saw the expense ratio as a bit on the high side. As a friendly reminder, if you don't mind, please hit the like button and subscribe to the channel to support the channel. Thank you. Now let's get into the number 2 ETF. That's the second on the list, which is the Vanguard High Dividend Yield Index Fund ETF, ticker VYM. Those of you that are used to this channel will know that I'm a big fan of Vanguard because I like their low-cost ETFs. Now, this ETF has a 48.5 billion net asset value base with a 2.79% yield, which is lower than the yield we saw on the previous one. However, the decent expense ratio of 0.06% is what makes me prefer this ETF to the previous one. Again, the sector weightings are quite diversified across the different sectors, with the financial services having the biggest chunk, followed by the consumer defensive and thereafter the healthcare sectors. Now, JP Morgan has the highest weight in this ETF at 3.53%, and we have other household names also holding quite decent positions in this ETF. The top 10 holdings account for barely 24% of this ETF, which again speaks to the diversification on this ETF. So Vanguard comes in as number 2 because I really like the low cost of this ETF. And bear in mind, like I always say, over a long period of time of compounding, the expense ratio will definitely be a major consideration. Finally, the number 1 ETF on my list, the best one I like of all the 3, is the Spider Portfolio S&P 500 High Dividend ETF, ticker SPYD. The ETF is a 5.28 billion net asset ETF with a decent dividend yield of 4.75%, guys, and an expense ratio of 0.07%. Now, notice the expense ratio of 0.07% is close to what we saw in the Vanguard. However, notice the superior dividend yield, 4.75%, compared to what we saw in the Vanguard at 2.79%. That's one of the reasons why this is number 1. Another reason would obviously be the sector weighting, which is pretty diversified across financial services, real estate, utilities, energy, and other sectors. Now, the top 10 holdings shows companies like Seagate, ConocoPhillips, Simon Property Group, the real estate company, Public Storage, which is a decent REIT, ExxonMobil Corporation, Marathon Petroleum, and companies that have a relatively high dividend payout. So by and large, the Spider Portfolio S&P 500 High Dividend ETF remains my best because of the lower expense ratio and of course the higher dividend yields. Compounding the dividend on an ETF like this should be able to grow wealth substantially over the very long term. Now, I would like you guys to do something for me. Let me know in the comment section what dividend ETFs you like the best, and also let me know what other category of ETFs you'd like me to have a discussion on. And again, as a friendly reminder, if you don't mind, like the video, subscribe to the channel as your main support to me on this channel. With that said, thank you so much for watching, and hopefully I'll see you all again in the next video. Cheers.